25 years when I retire. Well, what if you steered it a little bit better and put it into something that multiplies faster? That's the kind of philosophy I applied even back then, except I was very actively managing my stock portfolio.
Welcome to The Path to Wealth, the show about well-being, fulfillment and financial freedom. And I'm your host, Hannes Henschel. Welcome back to The Path to Wealth. Today we have Sandhya Seshadri from Multifamily for You. She's in Dallas and she really has the foot on the pedal in the DFW area. And she's going to shine some light on the difference between stock market investing and multifamily real estate investment for passive investors today. Welcome to the show, Sandhya.
Thank you so much for having me on your show. I have been so impressed by your quick growth since I met you, and I'm so proud of you for starting a podcast. That's pretty amazing and something I still haven't done yet in all my years of being in real estate.
Thank you so much for the kind words. And it's likewise. I've seen you really keeping the foot on the pedal over the last couple of years and kind of exploding into the space. And yeah, I would really love to touch up on where you started and how you got here, because that's a tremendous mindset to take so much action and the learning curve you went through. So maybe you can shine some light on that for us.
So as a quick summary, like many others, I grew up in India, a typical Asian geek with strong math skills, and dreamt of coming to the U.S. Made it here because of a college scholarship, came to Dallas, lived here ever since. So over 30 years in the Dallas-Fort Worth area. Have a high-tech background, worked in the semiconductor industry, and then realized very quickly in my corporate world that business folks make all the decisions. So got myself a part-time MBA while working full-time as an engineer. So the combination of those two led me to the stock market in addition to being an engineer at TI. And the stock market is where I made a lot of money. Even though I had a really good engineering salary, it was the stock market where I made money. But as an immigrant arriving here, my first few years, actually my first year at least, my food budget was more like $8 a week, And here I am after that, investing in the stock market and combined with my engineering salary into seven figures. That's only possible because, you just keep your nose on the grind and you keep working at it. But once I had a family, the corporate lifestyle was getting too demanding in terms of freedom of schedule. And I really wanted to be around when my kids got out of school and things of that nature. So that led me to finding also a way to mitigate my taxes because I was paying too much from stock market as well as my engineering salary back then. So I found real estate through multifamily investing. I attended a weekend seminar. It made a lot of sense to go into large multifamily, so I skipped the single family route because, again, I did not want to have to do things like fixing a leaky toilet on a Thanksgiving day. And I was not a handy person. I didn't grow up with that kind of a background to fix and flip houses as an example. So I went straight into large-scale multifamily, and that's where I saw not just the appreciation but also the tax advantages from things like depreciation. So it's been the perfect mix of using my math skills, my people skills, but also having flexibility of time. So I'm around as a mom for my family.
That's awesome. So rolling it back a little bit, where did that money mindset come from when you came here to have the savviness to not only have a highly paying job, but at the same time also taking that money and investing it into the stock market immediately and keeping your budget kind of low and going for the long game?
I think the biggest thing comes from, again, being so grateful for being here, but also realizing that the exchange rate, like in Indian rupee, was nothing compared to the US dollar. So I knew that I needed money to afford a certain standard of living. I looked at my house payment, car payment, and the lifestyle I wanted to live and realized, okay, so this is my gap. So let's say my gap was $4,000 a month is what I had to cover. How do I get there? Well, it starts with $100, right? And then $200 and so on to cover that gap of $4,000. So it's a step-by-step process. And you realize very quickly that, my starting salary was $36,000, And by the time I paid taxes and all my other expenses, my take-home salary was barely, $3,000-4,000 for the entire year. And I knew that was not going to get me to where I wanted to be. And so realizing that was the first step. So you have to be honest with yourself and realize where you're at today, realize where you want to go, and look at that difference and say, what's going to bridge that gap for me? And I realized that it was investing. So I followed what rich people do, which is they invest money. What do the middle class do and the lower class? Well, they just spend money. They spend money on a luxury to feel better about themselves. They go out and buy a new car, which I know is a depreciating asset. So even today, my car is 8 years old. I don't just have a brand new fancy looking car. So it's that mindset of an immigrant being, first of all, careful in your spending, truly realizing the magnificent value of the dollar, and then having a step-by-step process to say, how do I bridge this gap? What's going to get me there? And investment is what's going to get you there. The rich invest their money. They don't just spend it. 90% of what they make, they invest and keep multiplying it.
About the stock market performance, kind of when did you get in, and how does that compare to your current experience and what you're seeing in the multifamily space as a passive investor?
So pretty much like anyone else with a job, you know that your money goes into the stock market as the default. It's the only way we know. It's how we are raised, and money automatically goes into your 401k plan or mutual funds, right? But now you fast forward, I now have this real estate knowledge. We're in July of 2022, and year to date, the S&P 500 has lost like 18% as of July 8th. And I think your NASDAQ is down even 25%. I then compare that with my real estate investments, and I realize my properties haven't lost 25% in value. I know that for a fact. Renters are still paying rent every month. I see my passive checks coming in from my passive investments, and I see the financials on the ones where I manage and run the properties. So if I looked at the future and I say 20 years from today, I want to retire, right? And I have $100,000 today to invest. I know that if I look at the history of the stock market, your returns are averaging about 10%, right? If you look at a 30-year history of the stock market, your average returns are 10%. You might double your money every 7 years or so at best. Whereas with multifamily, almost every deal I've invested in passively, I do double my money every 5 years. This is from actual data and experience in cash flowing properties in really good markets in the Sunbelt states that you know about, right? Like Dallas, your Texas, your landlord friendly states, your Atlanta, Phoenix, North Carolina, Tennessee, the really good submarkets we have all identified as the places that have the population growth, the diversity of jobs, the income growth. So where is all the money pouring in from your Californias and your New Yorks? Well, it's pouring in. Institutions are buying up huge amounts of real estate in our Texas kind of markets. So in every 5 years, if you're able to double your money, what is that 100K going to become, right? If you look at a 20-year horizon, 20 years from today, where is my money going to go? Well, you're going to have much better returns because you're doubling your money every 5 years with real estate compared to the stock market. I've had investments I made in 2019 that have already been returned to me less than 2.5 years into, the syndication, and they've doubled my money. So 5 years to double your money seems pretty realistic. And so that's why I say evaluate all your investments, because you might be able to retire in 15 instead of 20 years if you put your investments in the right places. And really you're buying time, because that's the one thing that none of us have excessive, unlimited amounts of, right? Our time is very limited and finite in this earth. So if you want to retire and pursue a different lifestyle and you want to do it faster, you really got to choose your investments wisely. And most of us blindly put our money into mutual funds, never monitor the performance of those funds, never even look at the fees, many of us at least, especially when you put it into retirement funds, right? And then you just look at it, and we're not even talking about the tax advantages yet. So 10% of your paycheck blindly goes into some mutual fund every month. You rarely track it. You just say, I know I'm going to be fine in 25 years when I retire. Well, what if you steered it a little bit better and put it into something that multiplies faster? That's the kind of philosophy I applied even back then, except I was very actively managing my stock portfolio. I was not passively leaving it up to some financial planner out there using algorithms to put hundreds and thousands of stocks into one fund, right? That they don't even know what some of those companies do. Versus here in real estate, it's an actual property. You can visit it. You can look at its financials monthly. You can talk to the so-called CEO, which is your general partnership team, about the performance. It's just mind-boggling how well you could go into real estate. I wish I had discovered this sooner, where you just get to participate in real estate without all the headaches of being a landlord, those
Yeah.
leaky toilets and termites and trash, the 4 T's we talk about. So
Yeah.
I'm just so thrilled to find this investment finally, and I wish I had stumbled upon it sooner.
Yeah, every single time I contact my actual landlord, because I'm still renting, I think it's so funny because I'm like, I would never want to deal with that if I would be the landlord. But she owns just that one apartment
Yeah.
instead of an entire syndication. So
Yeah.
it's very interesting.
Yeah.
So
That's a
for
very
someone,
big difference too,
go
right?
ahead.
When you
Yeah.
have just one single family, I wanted to mention that if you have just a single family rental, and right now you're a single family rental kind of landlord, having your own property, when that one tenant doesn't pay, your income goes from 100% to zero, but you're still
Yeah.
responsible for the mortgage, the utility bills, and everything else. And that's where large scale apartments make sense. For about what I would make, I really looked at single family for that reason. And when I evaluated it, I might make a few $100s a month at best. But if there's any repairs happening, that's it. I lose even that. I may even be negative a couple of months because of that reason. And here is multifamily. Of course, we have repairs. You have more than 100 doors. If 5 or 6 tenants don't pay or the units are vacant, my income doesn't go down to zero. I just underwrite it as part of the economic vacancy. So, I mean, it's just like day and night, the difference between running large scale multifamily versus attempting single family.
So for someone who is getting started in this and maybe is scared of deploying money because, it's not as straightforward as just having it sitting in your Charles Schwab and deploying it in your 401k, how do they vet an investment, or how do they even go and find an investment in the first place?
They first have to probably get to know the sponsor or sponsorship team really well. I would say that's one of the most important things because you're betting on the jockey rather than the horse. And so, who's your pilot driving this plane for you? Are they, experienced? How do they understand the market? Have they run similar properties before? How do you get their references before you invest, right? That's where I would start. It's just like if you want to hire a contractor to do a $50,000 job in your house, you're going to ask for references. So same way, if you find someone, just like now you see Hans in his podcast, well, ask him for references. Okay, who are your previous investors? Who has worked
Yeah.
with you before? And vet them thoroughly. Make sure they have properties of a similar vintage in a similar location that they've operated, or their team has that, right? Not everyone is going to be the operator themselves, but as long as the team has that experience, that's what you want to make sure, because multifamily is a team sport. There's at least 3 or 4 sponsors running each deal. So you want to make sure they have experience in that market. The third thing is you want to make sure that the deal is in a good location, which has the movement of jobs, diversity of jobs, population growth, a high median household income. So just like the Sun Belt states locations I mentioned earlier, your Dallas, Fort Worth, your Atlanta, your Phoenix, etc., those markets. But even within that, the crime and the median household income, etc., is very important because real estate is still about location. So there are a lot of things you can't change in a matter of 3 to 5 years about the location of a property. So you have to make sure the sponsorship team has their experience, the property management team they hire has the experience in that local area, but that the area itself is really good to support those rents. Those are the 3 biggest things, and then references. Once you get references, then you can go down to the specifics of the deal itself, like the numbers, right? Because all the numbers are put into some kind of an analyzer spreadsheet. And so what is important in those numbers is what are the assumptions the sponsors are making when they put that data into a spreadsheet? Because any spreadsheet can be manipulated to produce pretty much any kind of return. So what are those assumptions? Are they based on actual, criteria vetted by experienced team members? Like in Texas, tax is a very big deal. So what do you assume for taxes? In Phoenix, you don't have to worry about that at all, or Atlanta for that matter. So you have to know the specifics of each location. And that's why I'm saying the experience of the operating team in that market and how they underwrite is so crucial. Now, let's say they are predicting a refinance in 2 to 3 years and they put that in the underwriting. I would say that that's more risky because what if you're trying to refinance today, which is July of 2022, and the interest rates aren't so great, right? Then you may not be able to do that. So that's more of a speculative thing you have in your back pocket. Hey, interest rates drop, I'm able to refinance. Okay, it makes sense, let's do it. But don't assume that into your underwriting, right? And another thing I say about underwriting itself is what kind of rent bumps are you anticipating? What kind of sources of other income do you have? So a rent bump cannot just be assumed because you feel like you could compare it to an A class property when in fact you're purchasing a B or C class property, right? So the comparison has to be a similar vintage, similar amenity kind of property within a 1 mile radius, maybe even on the same side of the highway. Like little particulars like that matter. So look at it on a Google Earth map. Look at what's around it, right? Look at what the crime data shows, a neighborhood crime, neighborhood scout, or some website like that. So all those details do matter because you are making a $50,000 type of investment or you are raising capital for a deal where the investors are putting in that kind of money. So definitely scrutinize it more carefully. Take your time to really get to know the sponsorship team before investing your money. And then once you do that, once you vet them and they produce results for you, then you get over that hump and that fear. It's just like the first time you invested in the stock market. How did you do that, right? How did you put that $10,000 into some random mutual fund? Well, you probably trusted your financial advisor or you trusted your company. You have no idea who's actually deciding what individual stocks go into that mutual fund. And I don't know how many of you actually read the prospectus of that mutual fund, right? But you did some level of screening. You have some level of comfort that, hey, Charles Schwab is a big company as an example. And so I know that my money is at least insured or something like that. Well, in this case, try to see if you can visit the property, make sure it's a clean title search, see if they have a syndication attorney with a reputation who's in charge of putting together all the legal paperwork, ask about the worst case scenarios, and see if you can invest a small amount in one deal after you've done your thorough vetting. And I have a vet sponsorship team checklist as well that I can make available to your listeners if they would like at the end.
Yeah, sure, we can add it in the show notes. So, but everything you just mentioned does sound a bit overwhelming for somebody who would just get started. How can they educate themselves to get into the right headspace to make, because $50,000 for many people in reality is not a small check to write. And so it's quite a learning curve. And I think it takes a step to move through that. And all the vetting you just mentioned seems rather complex for someone who's just getting started. So how can you help them or guide them to get started?
The vetting does take some time. It always starts with education in anything. If you've put money into the stock market without truly understanding it, then that makes you more of a gamble. And so in this case with real estate, I would say that start studying and getting familiar with the terms, right? And if it seems like it's a lot of terms, I don't want to understand it, then we always start with a gut feeling, right? Is the location good? That's an easy thing you can check. Anybody can check a location pretty easily. And then next thing is get a reference for the team members, right? Have they invested previously with someone you know really well? Those are the two easiest ways to get started. Like for me, I joined a mentoring program, so I knew that I had coaches, mentors, etc. to speak with before I invested my money into the first deal. And that's how I got over that hump. But I had already invested previously in things like the stock market in large sums of money. So investing a large sum of money wasn't as big a deal as, oh, am I going to lose all of this by putting money into this deal? Well, I had to drive and see the property. My very first property that I invested in passively, I drove to see the property. I made sure the syndication attorney was legit, the title was legit, and I made sure these coaches vouched for the team members who were going to run this property as good people. I mean, you never know how a deal is going to go, but at least they said these are honest, hardworking, good people who are going to stay focused on the property. And I met with them before I invested with them. That's how I got over that hump. So I didn't really know all the details of underwriting to be able to thoroughly vet the deal itself, but I trusted the team, and that's where it starts.
Yeah. So it goes back to relationships, and I think we speak about that quite a lot in most episodes, because it's a relationship business at the end of the day.
Yes, it's a relationship business, and word goes around fast. If somebody has a bad deal, you know about that sponsor and you avoid them. So there's circles, there's several different groups actually who are only targeting passive investors, and they form like a passive investors club, and there's a lot of Facebook groups, etc., from where you can learn, and you can certainly use my checklist. But if you commit to this learning, 30 days from today, you should have a lot more knowledge. If you simply spend 20 minutes a day listening to a podcast like this or some other episode and writing down 4 or 5 key terms that you want to learn more about. And LinkedIn, Facebook, all of them have so many groups and so much free content out there. And there's a lot of great books as well to get started on the learning process, whichever style you like to learn. You know, on your drive to work every day, you could listen to one podcast episode that would educate you on one aspect of multifamily investing.
Yeah. Talking about books, what is one of your favorite books when it comes to money or mindset?
Atomic Habits is one of my most favorite books. It talks about the incremental effect of making small changes on a daily basis in your life and how that adds up to making huge strides. Like I just started making a little change every morning in my routine, and I said, I'm going to read for 20 minutes a day. It doesn't matter what book I read, but I'm going to read. And that just is not just help with the knowledge of reading, but it's helped with a whole reset of, okay, I'm in charge of my schedule. This could be a manic Monday morning, but I'm going to read for 20 minutes. It's going to calm me down. I'm going to learn something new, you know? So don't ever underestimate the effect of small changes you make on your daily habits.
And that goes both ways. I mean, I love the book, and it's scary to see the negative curve of it too, because it's like in 1 year, you're close to zero.
Yeah. Yeah, if you make one bad habit, I mean, let's just say it's junk food, right? And you start adding French fries to every meal. It's going to add up fast. You're going to see it on the scale, right? It's the same thing.
Yeah.
So, yeah. Replace one bad habit with one good habit, and it's amazing the effect that has.
Yeah. I think starting reading...
Fruits for fries. That's an easy one.
Yeah, fruits for... I love that one. I'm all about fruits. But fries are quite crispy and delicious at times.
Okay.
So in the current environment, you know, I've seen many syndicators holding back because they're scared of where lending is going. But on a 50-year average, you know, we are still below the average in actual interest rates. Where do you see yourself? I think you're more in the foot on the pedal part of the market.
Mm-hmm. So this is July 2022. I'm about to close one deal this month. I'm already under contract for another deal. I think that we just have to look at whether the deal makes sense when you underwrite it with a higher interest rate. I mean, my first home interest rate was more than 7%. Today, my deal is closing at 4.5%. I don't see any problem with 4.5%. I think if the deal makes sense and you have to underwrite it for a higher interest rate, then do it. That's what I say. In terms of interest rates itself, I'm looking at fixed debt as much as I can today, but as long as it has an easy exit. I don't want to be stuck with a large yield maintenance kind of penalty, so I'm doing a step down prepay. So if I had a bridge floating rate today instead, I would not know until the date of closing or very close to that how much I'm getting in loan proceeds. So one thing that's happening is when the interest rate fluctuates this much, lenders may cut back on the loan proceeds. So suddenly you might find out on the closing table that you have to come up with an additional $1 million. So let's say you still have an extension left and you're able to come up with that additional $1 million. The problem that happens then is that your shares are diluted for your investors. So then the returns for them are also a little bit less. So that's sort of the trade-off. That's why today I went with a fixed interest rate, because I could lock in the rate and my proceeds. And so it was more certainty in this time of uncertainty. And that's what my investors were looking for. They wanted that surety that my interest rate is going to be fixed. So if I can't sell the deal in 4 or 5 years, I could hold on indefinitely for 10 years, right? And that's a comfort level that I really needed today to be able to raise the capital I needed for the deal.
Yeah, certainly. I think
we're in here for a very good opportunity. There's a great opportunity right now, I think, for buyers, right? Because some of the prices are down from their peaks that they used to be, down by anywhere from 10 to 15%, and your interest rates haven't gone up that much to offset that difference in prices, I think.
Yeah.
So I'm able to get deals that underwrite really well for that 4.5, even 5% kind of interest rates with prices 10 to 15% lower than what they were at the beginning of the year. So I think the next few months is an excellent opportunity to do that. I do anticipate by the time the election year comes around that interest rates will drop. But between now and then, I'm definitely predicting at least one, maybe two more interest rate hikes to the tune of 0.5% each or so. So be prepared for that. And as long as you can underwrite based on that or lock in a fixed rate, I think you're going to be fine.
So how do you address that question from a passive investor? Because in the headlines right now, they're reading about bubbles and, interest rates increases. So they don't have the same level of insight as you have. Like, obviously, you already mentioned you see it as a buying opportunity. But if I were to come to you as a concerned passive investor, because I see that there's more passive investors kind of being uncertain because the overall environment is uncertain. And obviously we try to mitigate that, but how do you address that question?
Well, I tell them that rent is due the first of the month, and here's my actual numbers from 5 different properties, right? People are still paying rent. My delinquency hasn't gone up a lot like you would think it should, even though inflation is here. And that's because there is still plenty of jobs moving here. And then we're not in a situation like 2008 because you look at supply and demand, we don't have an oversupply of accommodations. Single family homes are still very expensive, and we're outpricing more and more people out of buying that first single family home. So maybe in the beginning they could have bought it at the age of 27. Well, now that's getting pushed out to age 29 or 30 as an example. So it's taking them longer to afford a single family home. So you are creating a renter's nation. So even in times of market collapse, there is an opportunity. In fact, more millionaires are born from opportunities when the rest of the world is fearful and standing in the sidelines. The ones who go in are the ones who come out as winners. So for example, if I was in 2008 today, what would I say? Hey, I want to be in foreclosures, man. I want to be in foreclosure insurance because I'm going to make money from that. Okay? Yeah. If I'm in the middle of COVID, I'm going to say, well, people need a place to live. Everyone's not working in their offices anymore. They're going home. And so my deals flourished through COVID, right?
Yeah, you and me kept buying, and so, we did great.
Yeah, we kept buying, right? So people always need a place to live. That's a very basic necessity. You're not talking about, first-class plane tickets around the world kind of spending. We're talking about basic human need, which is shelter. Everyone needs a place to live. And the statistics show that even if we built out as much as we possibly can, it's going to take us about 20 years to catch up. So there's not enough affordable places for people to live. This is a renter's nation.
20 years?
So either you're going to capitalize on it or you're not. And you've got to pick it in places where the rent control kind of laws are not going to hurt you. So stay in touch with the local, laws of your state. Try to pick landlord-friendly states. And if there is rent control kind of measures going on, kind of figure out what that might be. There are some properties with what we call LURA contracts, where you are restricted to a certain, cap on your rents, and see if that's going to be enough for you to run this property well, right? So when life hands you lemons, you make lemonade. So you work around the situation. But this is not a 2008 recession. We have a lot of demand and very low supply, especially of affordable housing. People are not affording their single-family homes. They're going to have to rent apartments. So if you want to put money in something that's going to thrive in a recession, it's probably going to be recession-resistant real estate in the right markets where renters are still paying their monthly bills.
Nice. I love it. So what is a final takeaway that you would like to give the listeners?
I would say that give yourself a finite timeline of waiting in the sidelines. Don't wait in the sidelines forever, because every person I know who is in apartment investing says, I wish I had started sooner. So get the education, commit to that 20 minutes a day or whatever that might be, so that a month from today you're making a decision. Not, I'm going to wait it out for another year. A year is too long to wait. Get that knowledge so you have more confidence. Get to vet those people. Say, I need 5 references for this kind of investing from different sponsors that I seem to like based on what I see on social media. Let me go vet them further. Maybe I have a friend in Atlanta or in Dallas who can go drive this property for me and verify that it's all legit. But write out what those steps are for you to feel comfortable and set yourself some deadlines. Otherwise, you will drift, and a year from today, you'll still be sitting in the sidelines without taking action.
Yeah. So one question I like to ask is, as a final question, what does a life well lived mean to you?
Life well lived is a life where I have made an impact. And that's an impact on my communities of my apartments. That's an impact on my investors and certainly my family. And I have the freedom to choose what I do every minute of almost every day.
I love it, especially the time freedom aspect of it. I think it's one of the key reasons so many of us keep the foot on the pedal to, stir it towards freedom. And where can people connect with you? Where can they find you, email you, or?
My website is the best place to find me. It's multifamily4u.com, where it is multifamily, number 4, YOU spelled out.com. And they can put their name and email address, ask me for my checklist, or send me a short message. I'm also active on LinkedIn as well as Facebook, and those are 2 platforms where I post a lot of content if someone wants to get educated more on this multifamily.
Awesome. We will make sure to add it in the show notes. And Sandhya, thanks again so much for giving us your insights on the multifamily real estate market and also comparing it to the stock market. It's a tremendous journey you've been on, and I've seen it from the side a little bit, how you're hustling. So thank you so much for your own hustle and sharing it with us and your time.
Thanks so much. I really appreciate you having me on your podcast. Good luck.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.